Welcome to Tax Alpha. Today we're going to talk about the difference between RSPs and TFSAs. Let's start with a definition of each. A registered retirement savings program is a tax-deductible contribution to an investment pool which is tax deferred. You will pay full rate tax when you withdraw. Your maximum contribution each year is based on 18% of your earned income of your prior year. Earned income is essentially going to be salary and self-employed earnings. Tax-free savings accounts, on the other hand, are contributions to a tax-free account, but there are no tax consequences of either contributing or withdrawing from that program. Since the inception of that program, the maximum contributions will have totaled $31,000 by 2014 and is currently $5,500 per year. So when to contribute to each? On the assumption that most people do not have the cash flow required to contribute the maximum amounts to both their RSP and TFSAs, we have to go back to tax results to determine which is your best alternative for this year. If you are in the higher tax bracket, essentially over $90,000 of, let's call it income for tax purposes, you're more likely to want to make a contribution to your RSP. That's because of the large tax deduction and the refund that will result. It will also be beneficial if you could see your way to be able to plan that your income will be less when you withdraw these RSP funds to get a lower tax bite than you got on the way in, on the way out. TFSAs, on the other hand, should be most often used if you are in lower tax brackets and expect to be in a higher tax bracket when you retire. Both programs allow you to top up unused contributions on an unlimited basis out into the future. The only difference is a TFSA will allow you that ability even if you withdrew some of your contributions only to be replaced sometime into the future. So now let's look at how to invest money in a TFSA and an RSP. First, if you get a refund on your RSP contribution, try not to waste it on unuseful things. The most tax efficient thing you can do is use that extra money to make either a contribution to your RSP or your TFSA. Once you have money in those accounts, what we attempt to do for tax efficiency is maximize, if you're going to use it in your program, high rate income or fixed income in both programs, given the tax deferral nature or tax-free nature that would otherwise be highly taxed if held in non-registered accounts. So when do we plan to withdraw from either program? Well, the tax consequences of withdrawing out of a TFSA, as I said earlier, are nil. So if you must withdraw money, take it out of your TFSA first. But it is best to keep your dollars in the TFSA as long as possible to get the tax-free compound growth inside that program at its utmost. You should try and defer the use of your RSPs as late as possible. The government requires you to begin to withdraw that money through a RIF or a registered retirement income fund at age 72. If possible, that is the most tax efficient thing you can do on withdrawal from an RSP. So let's look at the actual retirement cash flow of using your TFSA and RSP. Try to defer the use of your RSP as long as possible to age 72, as I said a minute ago. When you withdraw money out of it, you will be paying at high rates. Therefore, attempt to use any non-registered investments outside your TFSA as your first form of cash flow. This would allow you to bridge the difference between your constant pension income, for example, and the cash flow you require. You will then use your RSP to top up any difference on top. Again, try to defer as long as possible to keep it as tax deferred as long as possible. Because the TFSA is a relatively new program and the pool of money in it is relatively small as related to your other investment dollars, it is only used today as an emergency reserve. In about 5 to 10 years, as we continue to add money to our TFSA, it will be large enough and may well replace our non-registered money, and it will be a fundamental part of our cash flow requirements in retirement. So how can NexGen help you with your RSPs and TFSAs? Most of our corporate class structure is devoted to non-registered investors and providing a superior after-tax return. But because an RSP and a TFSA is tax deferred in any event, and there is no tax magic inherent in their structure. We would suggest you look to our experienced stable of financial advisors and managers to provide you with the type of return that you are looking for the risk you're willing to take in these investment accounts. Hope that helps, and we'll see you the next time on Tax Alpha.